Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from Christopher Aaron, founder of iGold Advisor and senior editor over at the Gold Eagle website. Christopher, it's always great to get you on the show. It's been a couple months since we've talked on the KE Report, although we have talked in between that at various conferences and phone calls and text back and forth looking at the markets. And I was really interested in the take that you have currently on where we are in the precious metals complex. There's a bevy of different factors coming together into a bigger picture outlook that you have, and we'll get into that in this interview. But we were talking about things like how a lot of newsletter subscriptions are seeing people leave their service after decades of being there, and then numbers are down on internet blog forums, and you're seeing less traffic and a lot of articles that are being read. And you're seeing crazy valuations when you look at gold and silver companies that have spent years amassing ounces in the ground. So just the valuation level where a lot of these companies are contrasted against gold breaking out to a new all-time high, silver breaking out above 30, and the way the precious metals look in foreign currencies. So tie some of that together for us as far as the sentiment backdrop you think we're in and the period of time we may be entering.
Yes, Shad, thank you for having me back on the show. If I can give one takeaway, it's that this moment that we are in right now, I'm talking right this exact moment in time, this is a once in a lifetime setup in the precious metals sector. The phrase that I am adopting from the late great Jim Sinclair, one of my early mentors and teachers on the precious metals markets, he used this phrase in the previous decades, was "this is it and it is now." And that is how I'm looking at the precious metals markets right now. I can't guarantee the future, but it's a once in a lifetime setup. And if someone has the risk tolerance for the precious metals sector and you're still listening to this talk, you really have to take a giant step back here and say, well, if this is a once in a lifetime setup, this doesn't come about every year or even every decade. Is this the time for me to, let's say, get more aggressive in the sector and at least have that possibility of altering the course of one's life? That's how I'm looking at this setup right now. Let's talk about a few of the specifics. As you said, Shad, gold in US dollar terms hit a new all-time high yesterday, all-time in the history of planet Earth as expressed in US dollars. Silver has had a nice recovery back up to 32 as we're speaking. But the interesting thing is, even though those things are true, when we look across the board, the sentiment in the precious metals sector, with gold at an all-time high, is the lowest that it's been in the last 5 years. And I could argue that in other components of the sector, especially silver and in the mining side of things, the sentiment and the valuations are the worst that they've been in the last 10 years. And so if you think about that, we've got the underlying metal, gold at an all-time high, and then the miners and the sentiment, especially in the mining sector, at, let's call it, a 10-year low. You don't get that setup every year or even every decade. It's not every decade that we're going to get gold in blue sky territory breaking out to new all-time highs, yet the valuations of the mining companies essentially sitting at decade or in some instances multi-decade lows, especially for the junior miners with defined deposits in the ground. And so, yeah, I'm seeing it from a sentiment standpoint. I've been publishing professionally for 10 years, so I get to see readership statistics, viewership statistics, new subscriber statistics. Numbers are nowhere near where they were either in 2020 at that peak when gold was like $800 less than it is today, or nowhere near where things were in 2011 when gold was about $1,000 less than today. Another interesting sentiment indicator, I mean, I can look at mainstream publications, go to your average websites and see, are they talking about gold on Yahoo Finance, on CNBC? maybe one or two of these websites have a little gold, bullet point somewhere on the third page or at the bottom of the main page, but it's nowhere near front and center. The other really interesting thing, if you go to Google Trends and start looking at some trends as far as popularity of certain terms, listen to this one. The interest in the phrase silver price, which is what investors search for. I know this because one of my partners on Gold Eagle, the owner of Gold Eagle, shares with me readership numbers as far as what do people click on, what sort of headlines attract more readership. Silver price is the most popular term for investors who are looking at gathering information about silver. They search for that phrase, silver price. Here we have silver at the same level that it was, actually higher now, where it was than 2020. It's $2 higher. It peaked at $30 in 2020. Now it's at 32. Interest in that phrase silver price is down by 80%. There is 80% less interest now in silver as an investment from people searching for it compared to 4 years ago, even though the price is higher. So, net takeaway here, we've given a lot of anecdotal stuff, a lot of data related points here. This is not a woe is me or woe is us sort of moment. We're not trying to say, boy, we should be in other sectors here. We want to have big, happy faces right now because this means that we're not near a top. This means that the sentiment is nowhere near yet what it has matched at other previous peaks in the precious metals over the last several decades. And so if we're not near a top, because you can identify tops by these sentiment indicators, if we're not near a top, yet we have gold on the verge of breaking out now to blue sky territory, that's telling me that this thing has still a long while to go before we get to any sort of significant top.
Well, Christopher, that's the most bullish I've heard you in years, man, and it is putting a big smile on my face. So I think it'd be nice to dive into a chart that kind of accompanies what you just unpacked there, and that is how the senior gold miners look in relation to gold. So a senior gold miners to gold ratio chart, and you can just see how undervalued the mining stocks, the precious metals miners are. And this is just looking at the seniors. It's even worse if we were to have a chart of the juniors. But walk us through what you see on this chart.
Yeah, exactly right. So this chart is the HUI senior gold miners. These are the unhedged gold miners. So they're fully exposed to the gold price compared to the price of gold itself. And we can very clearly see at the bottom, if you look at the 2011 to 2015 bear market bottom, this is just a ratio. So the lower that this goes, it means the better gold is doing. And the higher that this goes, it means the better that the senior gold miners are doing. So you can see when you look at the 2011 to 2015 bear market bottom at that range about 0.09, you can see what a valuation for the sector looks like at the end of a 5-year bear market, right? And then fast forward 4 years later, you can see what a valuation looks like in a once per century panic, the coronavirus panic, where people threw everything out the window, but on a relative basis, they sold gold miners on a higher percentage than they sold physical metal itself. And notice how that low in the coronavirus panic, once per century panic, notice how that low was almost the same level as the 2011 to 2015 bear market bottom. Now, fast forward to today and look where we are here as we start 2015, we can see that the red call out, we are closer to 5-year bear market lows or once per century panic lows in the valuation of the gold miners today than we are to any sort of top. We can see how when the sentiment shifts that first half of 2016, the gold miners more than doubled relative to the gain in gold. Gold itself rose up to 1375, but the gold miners more than doubled that gain. We can see after the coronavirus, the recovery into mid 2020, that was a top for several years. You fast forward to today, and you see that we are actually at the same moment that gold is breaking out to all-time highs. The valuation of the gold miners are much closer to multi-decade lows. And so if you then overlay the sentiment indicators that we talked about, and you're saying, okay, we're not at a top yet because the sentiment indicators are nowhere near the previous tops. Therefore, we have this rubber band situation going on right now where gold is breaking out into blue sky territory. And by the way, Shad, we talked about this off the air before we started recording, but I've gone back and reviewed gold in every major foreign currency right now: gold in euros, gold in Swiss francs, gold in Australian dollars, gold in Canadian dollars, gold in Japanese yen. I've done them all. And all of those charts are in a technical posture that the only thing we can call it is blue sky territory. It's this situation where it's broken every visible resistance on the charts. There are no more targets. And you just have a market where anyone who's ever bought gold in those foreign currencies is in a profit situation. And so, therefore, no one has any reason to sell. If everyone has made a profit on physical gold, why would you sell? I mean, yeah, okay, maybe you need to sell a couple ounces here or there to pay some bills. Or maybe you say, hey, there's a piece of real estate I want to buy, so I'm going to sell a little bit of gold. But if everyone in every major foreign currency has made a profit on gold, this chart is in blue sky territory. And so back to the gold miners, that is happening at the same time as the sentiment in the gold miners is much closer to multi-decade bottom levels. So you have this rubber band situation right now, and I'm simply saying, look, in my own personal accounts over the last couple of weeks, I have nearly doubled my exposure to the gold mining sector compared to how I was positioned at the end of last year. And the reason for that is because we have the data on the charts. I mean, anything can happen ultimately. If I'm too bullish and this is a top here and gold just reverses and starts a new bear market, I'll take some hits, but I'm positioned appropriately. I'm not investing capital that I'm going to need at any point in the next couple of years. So, even if worst case situation happens, I'm going to be okay as a human being. But from a reward to risk standpoint, when you look at the valuations and you say we're not at a top valuation in the gold miners, that's the section that I want to focus on for basically what is a once in a lifetime divergence between gold and the miners.
Well, Christopher, I want to respond to two things that you said and just kind of weave in some elements from our prior discussion here at the KE report. And that is that you were looking at where could gold move in a kind of blow off leg, like in a final move higher. And now that we're up in blue sky territory, not just in all global currencies, but I would also argue in the US dollar, we were at an all time high just yesterday. There are no levels above this. So everybody in US dollar terms is also in the money. And since there's no resistance levels above that you can see on a chart, I had mentioned to you, hey, you'd have to look at Fibonacci extension levels to even come up with where a resistance would come in. You actually did the exercise. You actually went and looked at where the Fibonacci levels would extend to. And so I want to get that level from you, but I also want you to tie it in, Christopher, with in the 1970s, at the end of the decade, we talked last time about how in the last 2 years, from 1978 to 1980, after going sideways to down, many mining stocks out of nowhere just ramped up 200%, 300%, 500% those last 2 years. So I want you to tie together where resistance could come in from gold, but also are we at that inflection point like a 1978 to 1980 level where we could finally see the mining stocks even outperform that move in gold?
Yeah, so as far as resistance goes, Shad, I have to say, I think the last semblance of resistance on the gold chart is basically where we are right now. It's this psychological, it's going to be this psychological test of 3,000. It's just a round number. We can remember back into our memory how 1,000 was quite a sticking point for gold back in 2008 and 2009. And of course, we know, functionally speaking, the 2000 level was quite a resistance point for gold, 2020 to earlier in 2024. And so here we are approaching 3000. And it appears to me that gold is going to need to chip away in this zone around 2850 up toward 3000 for a little while. Could be a couple months, plus or minus. But the bigger picture, you're right. Gold in every foreign currency has blown every resistance off the chart. There is no more resistance, and it's just levitating upward in every foreign currency. And the US dollar index is not strong enough. There's not enough room higher on the US dollar index, even though I do think the dollar could trend higher versus many foreign currencies over, let's say, the coming decade. But over the intermediate term, next couple of years, there's not enough room higher for the dollar itself to go for us to propose that, let's say, gold in every foreign currency is going to be in blue sky, but gold in USD is going to get capped below 3,000. There's not enough strength on the chart for the US dollar for that to happen. So, therefore, it does appear that gold is going to enter what we are going to look at in retrospect as a dramatic final wave. We could call it a fifth wave in Elliott wave terms, or just a final wave from a classical technical standpoint. Similar, yes, as you said, similar to what happened in the late 1970s. And actually, Shad, you said the last 2 years, but I would define it actually a little bit more narrowly. The final wave really in gold, as far as when did mining valuations start picking up in the 1970s into the final peak of January 1980, it was really the last 15 months of that move. It was like October of 1978 until January of 1980. And a lot of the companies that were down over the previous 4 or 5 years, you can look at Hecla. Hecla was actually around, and they were trading back then in the 70s. That's a silver miner. But so from 1974 to 1978, Hecla was down 85%, even though the price of silver had moved sideways from 74 to 78. Very similar to what we've seen in a lot of these junior gold miners here over the last 4 years. We have the metals flat to higher, and we have a lot of these companies down by 70 or 80% still that are sitting on defined deposits. And then in the last 15 months, Hecla went higher, not just by 200 or 300%, higher by 1,000%. And a lot of the junior miners were higher by 2,000 or 3,000% in the last 15 months of the move. So that is what a final wave would look like. It's the last 10% of the time of the bull market, and it features about 90% of the gains, especially for investors that can put money to work now, just in the very beginning of that final wave. You know, trying to estimate these targets for a final wave can be quite challenging. However, we're not totally blind. The general theme is that final waves tend to surprise most everyone to the upside. So you do a lot of your estimates, you look at any sort of visible trend structure that might be remaining. And then what we do is we go on and we plot Fibonacci extensions of previous cycles. And we say, okay, if the current cycle is going to, let's say, do a Fibonacci extension of a previous cycle or a multiple of a previous cycle, where do those numbers start to coalesce? And there's a little variability here because it depends on how one wants to define the bull market in gold. Do we want to say that we're in the same bull market that began in 1971 when gold broke free of the dollar standard? We could do that. I mean, technically speaking, it's been a bull market then for 55 years. So how much further is that bull market going to extend? Or do we want to say the bull market began in the year 2000 at 250? That makes some sense too. Or do we want to say the bull market began in 2015 because there was a almost 5-year pause from 2011 to 2015, and so we started there. So there's no one right answer. This is the sum of humanity coming together here and looking at what should this store of wealth be worth, the 5,000-year store of wealth. There's no human being that has the correct answer. There's no central bank that has the correct answer. There's no financial institution that has the correct answer. Everyone, myself, yourself, we are all trying to estimate a proper value for gold as we look at a final wave coming here over the next, call it 1 to 3 years. If I overlay all those Fibonacci levels, take them all, what I want to do is look for a convergence of as many Fibonacci extension levels as possible. So if I have 4 or 5 Fibonacci extensions that all merge in a similar price zone, but I have one that's $3,000 higher than all the others, I'm more prone to ignore the one outlying one and focus on the multiples that come in the same price zone. The more technical levels that meet in the same price zone, the higher the chance that the market is going to gravitate toward one of those levels. So if I do that right now with gold entering or on the verge of blue sky in US dollars, the zone that I'm looking for, the confluence of all these Fibonacci levels, really comes in the zone between, let's call it $3,800 and 4,700. And that's a wide range, yes, but it's actually not that wide in percentage terms when you think about the future. It's about a 25% zone. And when we're projecting a final wave that could go multiple thousands of dollars higher, let's say, on a potential, it's the best we can do. So that sets our general expectations. But then we don't just leave that and turn our backs on the market for the next 5 years and wake up one day and say, hey, are we at that level? This is the moment. No, as it's working its way higher, we then look for mini structures, mini trends, mini topping patterns, mini continuation patterns that are going to align up and give us targets within that zone. And we start to overlay these shorter term patterns with a long-term convergence zone, let's say in the 3,800 to 4,700 zone. And as it's working its way into that, that's going to give us a very clear sense of the end of a final wave as it materializes. We're not there yet. We're nowhere near there. And then we'll also want to pay attention to the sentiment indicators. From my readership statistics, when do my numbers start getting similar to how they were in 2011 or 2020? When do people start searching for the phrase silver price or mining stocks in the same way that they were searching for it in 2020, which was a 4-year peak? Right now, the interest in those terms is down by about 80%. As I said earlier, it's down by 80%. So we know that this is not top sentiment now. So it's like when all those things overline, the Fibonacci's, short-term patterns, sentiment, when we're talking 12, 24 months from now in that range, that's when we start dialing it in. For now, we focus on it doesn't look like we're at a top, and the mining stocks are valued closer to as if we're at a bottom.
Well, Christopher, another chart that we have talked about quite a bit, and it's going to be pretty telling to see which way this goes, is the Dow Gold ratio chart. And I think of the reason that there's not a lot of people searching for silver price or mining stocks in search engines, and why there's not a lot of traffic on precious metal sites, and while some of these mining stocks are at such crazy valuations to the low side, is because in general, the stock market has been doing really well. When you look at how well the general equities performed last year, most of the indexes were up 20%, just like they were the year before. There's been some big gains in gold, but there's been some big gains in the stock market. So when you look at the Dow Gold ratio chart, it's been flattening and kind of compressing into a large triangle. We've talked about this before, but give us an update now because you've actually added percentages onto this chart where if it actually breaks down in gold's favor, that could be a very large move over a long period of time. But if it breaks up in favor of the US equities, that's going to put the hurt locker on the sector. So how are you looking at this chart as we near a closer period of time towards the apex of this triangle?
Yes, that's correct, Shad. So now let's dig into this chart and talk about the specific numbers here. I'm blown away by what's happening here. A breakdown below the 14.95 level. You can see I've highlighted this on the chart for the listeners. 14.95, which is only 3.7% away, would constitute a break of this multi-generational consolidation in favor of gold. So the way to think about it is a 3.7% advance while the Dow itself is flat over the course of any several weeks coming up here is going to be sufficient for us to see the initial break of this Dow to gold ratio in favor of gold. And you can see that it's much closer to breaking in favor of gold, only 3.7% away, compared to breaking in favor of the Dow, which is still 17% away. So, in other words, I mean, Dow would have to advance by 17%, or gold would have to fall by $500 in order for that to break in favor of the Dow. I don't want to call a breakout until I actually see it on the charts, but I have to say, I am extremely pleasantly surprised here following this over the last several quarters that this is on the verge of breaking in favor of gold. And actually, the last week saw a 3.5% divergence. The last 7 trading days was a 3.5% divergence in favor of gold as all these tariff and trade war rumors were coming out of the Trump administration. And it's almost like the stock market just did a deer in headlights over the last week. And people were saying, well, if 1 minute we're going to have 25% tariffs on Mexico and Canada, and the next week we're not, and then we're having tariffs on China, and then, but maybe we're pausing for 30 days, and then maybe after 30 days we're doing it again. I mean, how do we operate our business? How do we operate if you're a multinational manufacturing company or you're doing importing or exporting to or from Mexico or Canada? How the heck do you operate with that kind of backdrop? And so we saw it in the last week where market participants basically just threw their hands in the air for general stocks and they said, oh, wait a minute here. I'm not going to be putting any more capital in there. And they said, just get me something that's stable in this kind of crazy environment. And we saw a 3.5% gain in the price of gold with the Dow perfectly flat for the last week. So, I mean, 1 or 2 more weeks like that is going to be enough to get this Dow to gold to show an initial break in favor of gold. And then, of course, we're going to want to watch for monthly closes. We're going to want to see one quarterly close in favor of gold. But this is the linchpin of the entire mining complex. This chart right here, the fact that this thing has not broken in favor of gold, and it's the only bull market in gold in which the ratio has not compressed strongly lower in favor of gold. You look at the 1970s bull market, that thing moved from 25 down to 1. You look at the 2000s bull market, it moved from 45 down to 6. This bull market in gold, it's completely flat. That is the reason why there's been so little interest in these mining stocks. That's the reason why our businesses, even though we are involved in the sector of mining for these metals that are at either decade or all-time highs, the interest has actually remained quite subdued. And this is a good thing. This tells us that the top is not in yet. But it's because of this Dow to gold. It's because the average person who just invests in their tax-free savings account, 401k funds, superannuation funds in Australia, US, or Canada, depending on which one you're in, they've done just as well in their index funds as someone investing in gold. And this is the only time in history that that's happened. So, I mean, gold in USD is on the verge of blue sky here, like for real. Dow to gold is close to breaking down in favor of gold. You can't even imagine what this is going to be like if it truly does that. And then we have a period of some years ahead where gold is actually outpacing the Dow. You have no idea how different the sentiment can be in this sector if that actually happens. I lived through the last time that this ratio was really moving strongly lower in favor of gold, that 2008 to the 2011 window. And it was life-changing for me at the time. And I am positioning myself for another life-changing setup here. If I'm wrong, Will I take some hits? Yes. If something comes out from outer space and starts a bear market in gold tomorrow, will my positions go lower? Yes. But the sum of the evidence in front of me at this point says that we are not at that reversal moment and that there's still a lot of catch up in the mining equities to go as gold enters blue sky and as potentially this Dow to gold ratio breaks in favor of gold.
Well, and that kind of sets up our final chart together here on this call, Christopher. And that is a chart you're providing that looks at the Canadian Venture Index. It's an ugly looking chart for the Canadian Venture Index from 1999 to present. And that's because the pricing and the volume and everything has pulled back so much. So I guess let's end with what a lot of people on this call are invested in, and that is equities that are exposed to the potential upside in gold. While people invest in gold and silver for different reasons, a lot of times it's as a safe haven or a store of value. They're usually invested in the equities for the leverage that can happen in a bull market. So walk us through what you see on this Canadian Venture Index chart.
Yes, so remember there's about 2000 plus or minus companies that trade on the venture exchange. This is an index of about 120, 130 of them. About two-thirds of the index is composed of commodities and natural resources. Of that two-thirds, so it's heavily weighted toward commodities. Of that two-thirds, a lot of it is energy, oil, natural gas, uranium, base metals, and there is a good percentage, a good chunk of precious metals. So I'm not trying to say that this chart is a perfect overlay of precious metals themselves. But when this chart, for example, I told you that the period of 2008 to 2011 for me was life changing at the time for me back when I was at the end of that bull market and investing in 2008. And look at what the venture index did from 2008 to 2011. It moved from about 700 up to 24, 2500. So call it a quadrupling. So having this index moving in our favor if we're investing in the smaller mining companies is absolutely critical. You look at the bear market from 2007 to 2020, in which this index fell by 90.3%. And you remember that an index cannot go to zero, but it had fallen by 90%. That starts to become an interesting sector to take a look at from a value proposition. You look at the fact that here since basically 2013, it's been moving sideways in this 12-year base. That's a healthy backdrop, not for catching any mainstream attention like Nvidia stock or Bitcoin, but for setting up the potential for a nice sustained bull market here starting soon and over the next couple of years. The classic phrase from technical analysis is the longer the base, the bigger the move. You got a 12-year base that's setting up here. And furthermore, it looks like it's taking the shape of an inverse head and shoulders. You can see the left shoulder from 2014 to 2018, the more pronounced head formation into the low of 2019 and 2020. And then it looks like it's trying to carve out a right shoulder right now. And it is also bumping up against this downtrend back from 2021, the blue dashed trend. So, I mean, from a technical standpoint, if you think about it, we are seeing the precious metals either in blue sky or looking strongly bullish. In the case of silver here, having recovered that $30 mark, blue sky as far as gold are on the verge of blue sky. Overall mining sector severely undervalued versus the metals due to all those sentiment factors that we talked about, Dow to gold, and we can see that expressed in so many different ways. And then so we take it to the final piece of it for people that are looking for the outsized gains, because that's what we're doing. If we are investing in junior resource companies, we're not in it to try to get, the 20 to 30% higher that the GDX might move or some of the index funds. We're looking for it for the 200, the 300, the 500% higher in some of these instances. That backdrop looks like it's turning upward, whereas it has not been for the last 4 years. So You put everything together, this rubber band analogy, as I said in the beginning, it is not going to be every year, even every decade in one's investment career, where you have the metal itself at all-time highs and you have most of the companies involved in exploring and developing for this metal at or near all-time lows. That's not going to happen every year or every decade in one's investment career. It is the situation right now. My best take on it is it's not going to last forever. It's not going to last too much longer. I'm seeing some initial green shoots in this sector. There's a couple companies I've been watching closely that very quietly have tripled off their lows in the last month or so. They still need to rise a lot just to get back to where they were a few years ago. But you can see how quickly companies can double and triple in value. So I think for investors who understand the big picture, this is what I'm doing. This is why I'm sort of backing up the truck on my personal accounts and I'm advising or suggesting, I should say, to our premium subscribers across the board that if you have the risk tolerance, this is the time to be topping off your portfolio. It's what I'm doing personally. The sentiment indicators support it, and the charts support it as well.
Well, it's a great place to wrap it up on that note, Christopher. Again, this is the most bullish I remember you being in years of talking to you and in following your work for a long time. And I think we provided a lot of chart-based evidence as well as sentiment data to kind of point out the juxtaposition we're seeing in pricing in the commodity versus the pricing of the commodity equities and the resource stock. So it's an interesting juxtaposition. It does sniff of a big opportunity, and we'll definitely be keeping tabs on how this all unfolds. But I really appreciate you breaking down your bigger picture vision with us here at the KE Report. And if people want to get more insights from Christopher, definitely click on the link below this interview. It takes you over to his site, iGold Advisor, where you can learn a little bit more about what he offers subscribers. And there's also a link to the Gold Eagle website where you can follow along with his writing. Christopher, as always, great having you on the KE Report and looking forward to our next conversation.
Thank you so much, Chad, for having me.